We'll start now. I hope you are hear me. Okay. So, welcome to our session on how a swing trading system actually makes money. Okay. And why small risk per trade is the whole game and the setup that produces it. This setup will be shown by Mr. Suny Patwal, who is a CMT and the founder at Trabot Solutions. Okay. Regarding me, my name is Sovit Manjani. I'm the CEO of YUBHA and Trading Heads. Okay, we are the premier prep provider for CMT designation. Okay, and we also coach for systematic trading and investing. Okay, we also have a firm called Sentient Analytics where we do AI-driven analytics for asset and portfolio analysis, integrating fundamental and technical analysis. Okay. So, regarding the presenter today, Mr. Suny Patwal, okay, he's a technical analyst and an algo trader with a strong foundation in both market study and technology. As a director at Trabot Solutions, he works on developing technical analysis frameworks, building automatic trading systems, delivering training programs for traders and market enthusiasts. He's a co-creator. He's the creator of Checkpoint, which is the YUBHA CMT exam preparation tool that supports effective revision through personalized quiz-based learning. His areas of focus include market profile, applied technical analysis with practical approach to strategy design and market interpretation. Earlier in his career, he worked as a software developer in the banking and finance domain, gaining experience that now helps him integrate technology with trading solutions. He completed his CMT designation in 2025. He got his CFTe designation in 2023. He has BE in electronics and communication. Okay, so over to you, Sunny. Looking forward to learn from you. You'll have to unmute yourself.
Yes. I was on mute all this time. Okay, so thanks, sir, thanks for having me. And you already gave enough description about what I do and who I am. But many of the people I think are from the CFT group, so they know me. But anyway, I'll give an introduction, a brief two-liners for people who don't know and who are new. So hello everyone, and welcome. I'm Sunny, and for the next hour, I'll be taking you through a swing trading system, how it works, and why it makes money. A quick word about me, and then we'll start. I'm a CMT and CFT, and I run Trabot Solutions, where we research and test technical analysis methods and build tools around them. I spent about 15 years in software prior to this, and before I came to full trading full time, and I've been in the markets for roughly around 10 years now. I do market profile on the intraday side, as Sovitsa said, and breakout swing trading in stocks. And today is only about the swing trading. So that's enough. Let's get to work. Let me know, Sovitsa, if I'm going too fast because sometimes I get in the zone and then I move on fast. Okay.
Yes.
So three things before we start, a formality. So one, this is education. It's not an advice. I'm not going to name a stock and tell you to buy. What I'm giving you is a method and the reasoning behind it. Two, you ask questions whenever they come to you, put them in the chat because I'll try to go non-interrupted because there is a lot of things that we'll be covering in this session. Put them in the chat and don't sit on a question for like 40 minutes waiting for the end of the session, waiting for the right moment. Just put your question in the chat and we will have 1 full hour of questions after this. So bring your charts and bring whatever you are stuck on. Three, every number you will see today is arithmetic on a made up account. It's not my track record and it's not a projection. I use numbers because numbers make the point clear. And three more because these matter. Every chart I'm going to show you is an Indian stock because that's what I trade. But the method isn't about India. It works anywhere. There are liquid stocks that are actively traded. Every chart here is more than 3 months old. That's per SEBI guidelines. So if a question comes up later and I pull up something current to explain a point, please take it as an illustration of an idea and nothing more. It's not a recommendation on that stock. And the third one, this session is based on a system we actively trade and teach at Trabot. So some of what I say will be new to you, and some of it may go against things you have been taught. I want to be clear. I'm not arguing against any theory, and I'm not arguing against any book. I'm telling you what works for us and what doesn't. Today is about edge that's available in swing trading. Your system may be different from ours, and that's completely fine. Okay, let's begin. So, part one, why small r is the whole game. I want to be upfront about how today is structured because it might feel a bit odd at the start. Most sessions on breakout begin with a pattern. Here is a base, here is a contraction, here is where you buy. I'm going to do all of that, but in the second half. The first half is about the arithmetic underneath the pattern. I have built it this way on purpose. In my experience, if you learn the pattern before you understand the arithmetic, you end up using the pattern in a way that doesn't help you. You can take the exact same setup I take and still not make money on it. So stay with me through part one, even if it feels that we are going in circles. By the time we get to the charts, you will be looking at them differently. So here's where we are starting. Two traders, same stock, same breakout, same move afterwards. Both of them risking exactly the same amount of money. One of them makes 11 times what the other one makes. Not because he's smarter, not because he picked a better stock, because it's the same stock, not because he has more conviction on or a bigger account. Okay, the only difference is the distance between where he bought and where his stop was. That's it. That's the whole difference. Now, if you are thinking that can't be right, at 11 times is too much. Good. That's the right reaction. Let me show you the numbers and then you can decide for yourself. Okay, before I show you, I need to give you one word because I'll use it about 200 times today and I don't want anyone lost. The word is R. So R is a distance from your entry to your stop. That's all. If you buy at 500 and your stop is at 480, your R is 20 per share, 1 unit of planned risk. Once you have that number, you can describe everything after it as a multiple. If a stock goes to, suppose say 560, that's rupees 60, which is 3 times your R. So you made 3R. If it goes against you and the stop is hit, you lose 1R. Why bother with all this? Because it makes trades comparable. A 20 stop on a 500 stock and a 60 stop on a 1200 stock looks like different trades. In our terms, they are the same thing. You can compare them, you can average them, you can build a system on them. Now, here is a part I want you to understand because it's the opposite of what most people assume. Small r does not mean small position. It means the opposite. Think about it. You have decided you are willing to lose 10,000 on a trade. If your risk per share is 20, you can buy 500 shares. If your risk per share is 50, you can only buy 200. Now it's the same money, same 10,000 at risk. The tighter stop bought you a bigger position, not a smaller one. And last thing, R is set before you enter. Once a trade is open, you can't change it without breaking the arithmetic. That's why so much of the part two is about being patient enough to enter where R is small in the first place. So here are two traders, same stock. It breaks out from a base at 500. Both have a 10 lakh account and both are risking 1%. So 10,000 rupees each. Same risk budget. Now trader A has this on his list. He buys at 500 at the pivot and his stop goes at 480, just under the base or just under the pivot. Trader B didn't have it on the list. He sees it 2 days later at 575. It's making new high. It looks strong, so he buys. And here is his problem. He can't put his stop at 480 because that's 95 rupees away. So he does the sensible looking thing and puts it under the last small pullback. Suppose say at 520. Now watch. Traders A risk per share is 20. Traders B is 55. So for the same 10,000 rupees, A buys 500 shares and B buys 182. Now, both of them are right. the stock goes to 600. Now A captures 100 rupee per share, B captures 25. A makes 50,000, B makes 4,450, right? Same stock, same move, same money at risk. And there is something else that's easy to miss. B isn't only making less loss, sorry, he isn't only making less money. His reward to risk is 0.45 to 1, which means he is risking more than he stands to make. And he is much more likely to be stopped out on the way when a normal retracement of 5 or 6%, or this normal 5 or 6% pullback is normal in a uptrend. So which will take the stock from 575 to around 540. Now A can sleep through it, okay, because his buy price is even lower, but B will be taken out completely. So okay, so remember this slide when we get to the charts, because everything in part 2 is about putting you into the A's position. So let me show you why that happens. This is the most immediately usable thing today, and I want you to be able to do it on paper by the time you leave. Shares equals risk amount divided by entry minus stop. That's the formula, nothing clever in it. You fix the top, which is the rupee amount you are decided to lose. Then the bottom decides everything, right? R sits at the bottom. You half it and your position doubles for the same risk. So let's compare three trades here. Same account, 10,000 at risk on each. Trade A, buy at 500, stop at 475. Risk per share is 25. So 10,000 divided by 25 is 400 shares, 2 lakhs deployed. Trade B, buy at 200, stop at 170, 30 rupees of risk, 333 shares, only 66,000 deployed. Trade C, buy at 1200, stop at 1140, 60 rupees of risk, 167 shares, 2 lakhs again. So look how different those are, right? So one position is 2 lakh, another position is 66,000. But if a stop is hit on any of them, you lose exactly 10,000, right? Every time. That's what sizing from the stop means. And notice the order. The chart tells you where the stop goes, and then you work out how many shares. So never the other way around. So most of you who are pursuing the CMT will find this a straightforward thing. Uh, for those who are new to this, it just takes 2 minutes on paper to calculate. And after 20 trades, you will be doing it without thinking about it. So here's what that fixes. The most common way to size position is equal weight, right? 10 lakhs, 10 positions, 1 lakh each. It feels fair. Look at the left side. The stock A gets 1 lakh with a 5% stop. So you are risking 5,000. Stock B gets 1 lakh with a 15% stop. So you are risking 15,000. On your screen, these two look identical. In reality, one carries 3 times the risk of other, which means one loss on B wipes out 3 wins on A. The portfolio is not balanced. It's weighted towards whichever positions happen to have the widest stops. And those are usually the ones where the structure was loosest. So now the right side. Same two stocks, sized on risk. A gets 2 lakhs, B gets 66,000. Very different capital, but identical risk. And see what happened. The tight stop earned a bigger position, not because you liked it more, because the structure deserved it. That's the first play. That's the first place. Small R pays you, right? It isn't just better arithmetic on a trade. It's what makes the whole portfolio behave in the way you can predict. Now, let's talk about win rate, because I show you the numbers. Let me ask you something before I show you that numbers. Look at these three systems. A wins 80% of the time, B wins 40, C wins 55. If that's all you know, which one would you trade? Put it in chat. So you only know the win rate. You don't know anything else about that system. So somebody asked me to unmute. Am I audible?
Yes, Sunny, you are audible.
Okay. I don't know. I don't see the chat option. Okay.
No, there's no
Chalo.
message in the chat as yet.
So, okay, so that was worried me, right? Are people listening or what? Or they lost? Okay. Anyway, so if you ask most people which system they will pick, just by looking at this matrix, right? Not the overall matrix, just the one line, right? They will pick A, because 80%, right? 4 out of 5. Now look at the row that matters. System A makes 2000 when it is right and loses 10,000 when it is wrong. Expectancy is minus 400 rupees a trade. It wins 4 times out of 5 and it still goes backwards. System A wins only 40%, but it makes 8,000 and loses 3,000, right? Plus 1,400 a trade, it makes money. And C, the middle one, is actually the best of the three. Now think for a moment and understand what that means. A person trading A wins constantly and feels like a good trader, and the account is shrinking. The person trading B loses 6 times out of 10 and is compounding. The thing separating them is R. If the It's the size of the loss compared to the size of the win, nothing else. So expectancy. Expectancy is win rate times average win minus loss rate times average loss. Positive, the system makes money over time. Negative, it doesn't. So win rate is one input, and honestly, it is the least important one. So just one second. So let me explain where very high win rates come from because it's useful to understand the mechanics. The first way is when there is no stop in place. If every losing position is held until it comes back, the win rate climbs because most stocks do come back eventually. But the problem is with the ones that don't. A single 50% loss takes 25 small wins. The second is when the profits are booked very early. Taking the gain the moment it appears, it lifts the win rates and it feels good. It also means the winners stay small while the losers are given room, right? Which is opposite of what the arithmetic needs. And the third is premium selling. Most genuinely 80% plus win rates come from selling premium, small amounts collected very consistently with occasional large losses. This math can work well when the tail risk is managed. It's just a different structure from what we are doing today. So whenever we see a win rate, the number we look for next is the average loss when the system is wrong. That's the number that tells you whether the win rate means anything. Don't worry if you have been focused on the win rate because every one who is new, right, who starts does that, and I also did that. Okay, because it's one of those ideas that sounds so obviously right, it doesn't get questioned. Okay, moving on. So here is what an honest swing system looks like. Win rate somewhere between 30 and 55%. That's where good VCP based systems sits, including ours. Average win 2 to 3 hour, average loss 1 hour because losers are cut at a stop every time. Put that together at 40% and you get 0.6 hour plus 0.6 hour per trade. That's the edge per attempt. Now, being wrong 6 times out of 10 isn't a flaw here. And I want you to hear that properly. It's the designed operating condition. It's what the system is supposed to feel like. If you expect to be right most of the times, you will leave this method within 3 months. The profitability lives entirely in the gap between the 3 hour and 1 hour. And that gap exists because you entered somewhere the stock could be close, which brings us to the question the rest of the session answers. Where on chart can R honestly be small? That's it. Everything I show you after this, stages, bases, pivots, is me answering that one question. Okay, before we get there, let me show you what plus 0.6 R looks like over 50 trades because people usually imagine something much smoother than this. This is just one of the Monte Carlo simulations of a sequence of wins and losses for a 0.6 R expectancy. We have this on our website under Trabot School tab, where you can change these numbers and run the simulation again and again, and to see how the equity curves looks. You can also create a return distribution curve of 1,000 simulations, which give you the statistical edge your system has. So I'll share the Trabot school link later, and if you want me to show it, we can do it in the Q&A round. For now, it's beyond the scope of this presentation. So 50 trades, 20 wins, 30 losses, ending at plus 30 R. Look at the shape rather than the endpoint. It's never a straight line. A series of losses can appear together, and there are pullbacks often all the way through the journey. And then there is that section in the middle, around 21 to 30. Let's talk about that. So 9 losses in 10 trades. Here, nothing went wrong. Not one rule was broken. Every stop was placed properly. Every entry was at pivot. Every loss was exactly 1 hour. This is simply what a 40% win rate feels like from the inside. And I'll be honest with you, this is where people stop. This is the most common point at which somebody leaves a method that's working. There is a reason, and it is not weakness. Losses feel about twice as strong as the same size of gain. That's loss aversion, right? It's one of the best documented findings in behavioral economics, and it applies to all of us. 9 losses in a row doesn't feel like normal variance. It feels like something is wrong. So it gets tempted to move to something with a higher win rate or and weaker expectancy. It feels better, but it earns less. And whoever stops at 30 never get to see the trades, right? 31 to 50, which is where the entire result of this sequence came from. So the only difference I know is understanding the arithmetic well enough so you trust it over that feeling, not believing in yourself, actually knowing your numbers. When you know your system is plus 0.6 R per trade, a run of losses becomes what it is, right? Normal stretch of a system doing what it was built to do. So don't worry, this does get easier, but it gets easier because of the maths and not because you have decided to be more disciplined. Okay, so moving on, and here is why risk per trade has to stay small. So drawdowns are not symmetrical, and this catches people out. So you are down 10%, you need 11 to break even. Fine, that's normal. Down 20, you need 25, manageable. Down 30, you need 43. Now it's hard. Down 50, you need 100% just to get back to where you started. Think about that. You need to double your money to break even. Down 75, you need 300%. Now let's connect that to the last slide. 9 losses in a stretch is a completely normal thing for this system to do. At 1% risk per trade, 10 losses in a row cost you 10%. Uncomfortable, but survivable. The system recovers. At 5% risk per trade, the same 10 losses cost 50%, which is why we keep risk per trade small enough that the normal losing stretch stays recoverable. Same system, same trade, same run of bad luck. One account carries on and one doesn't. The difference is the size of the bet. So surviving matters more than maximizing. So one more layer and then we get to charts. Everything so far has been one trade at a time, but you will hold several, and the total risk open across all of them is what a bad week actually cost you. That's portfolio heat. So for a swing account, 5 to 8% total heat is reasonable. 5 to 8 position at 1% each, or 10 to 16 at 0.5%. There is a catch, which is correlation. If everything you hold is in one sector, they don't behave like separate positions. They move together, and your real heat is higher than the sum suggests. And when you are at the limit, you stop. No new trades until something hits a target or gets stopped out, which means sometimes a good setup goes past and you can't take it. That's uncomfortable. You do it anyway. But notice that small r helps here too. A tighter stock means more positions inside the same heat budget, more shots at your edge, right? Same total exposure. That's the third argument for a small r, and a very reasonable one. Okay. So four ways to take arithmetic that works and undo it. So I've done at least two of these myself, and I'll tell you which. So first is widening the stop. The trade is going against you and you move the stop down to give it room. You just increased your R after the fact. The 3R winner is now less than 3R winner, and the edge goes with it. Second is cutting winners early. You are up 1 hour. It feels good, you book it. Now you need a win rate above 50%, and this system was never built to give you that. So I've done this one. Third is chasing extended stocks. Every rupee above the pivot widens the your R. Same stock, same setup, different arithmetic. So we also did this initially. Fourth is sizing on conviction. So doubling up because the setup feels strong. The trouble is that feelings and results are not well correlated. So eventually, the biggest loss lands on the biggest position. And notice what all four have in common. Every one of them is a decision made after the trade is open, which is when the judgment is at its weakest. So that's the whole argument for planning your trades in advance, before your entry, and even before the market opens. Next one. So now the whole job becomes this: find the places on a chart where R can honestly be small, not where you will like the stop to be, where the structure genuinely supports a close one, and where the move that could follow is worth several multiples of it. That's what the rest of the session is about. So part two, the setup that produces a small r. Now the charts, and I'll keep coming back to r at the end of every section because that's the point of each one. So first filter, stage. I'll move quickly here because many of you already know this. First thing, we do this on a weekly chart, not the daily. Stage is a slow structural thing. Looking at it on a daily just adds noise. Second, the line we use is 200 DMA, which is same as a 50-week moving average. Or SMA or EMA, it really doesn't matter. Use whichever you prefer. And then only two things tell you the stage: the slope of that line and where the price is relative to it. That's all. So stage one, basing. The line is flat and the price oscillates above and below it. We watch here. Stage two is advancing. The line is rising and the price is above it. This is the only stage we buy. Stage three is stopping. The line becomes flat again and price whipsaws across it. We protect what we have. And stage four is declining. The line is falling and the price is below it. We stay out. Now, that's the test book and it's worthy 90 seconds. That the part that actually matters is how you mark these on a live chart and in what order. Okay, that's the next slide. Here is how we actually do it. So most people open a chart looking for stage two because that's where they want to buy. We do the opposite. We look for stage four first because a decline is easiest thing on a chart to identify objectively. So step one, find the stage four. Two markers. The 200 MA turns from upsloping to downsloping, and there is a fall of roughly 35% from the high. Now that 35% is a guideline, not a rule. Don't measure it to the decimal. The reasoning is simple. A stock that's down about that much has broken its structure. And for our purpose, it is likely already been through stage four. The number is just a quick way of noticing that. The broken structure is the real test. Now, step two, draw the downtrend line, a line sloping down, connecting the highs. And while you are drawing it, try to bring the swing lows that sit at the same bottom below the line. That's what gives you the shape of decline. Step three, wait for that line to break. Prices move through it and then it usually stops and consolidates. That consolidation is the first base. Step four, and this is the one worth being clear about. That first base is what we call our stage one. Now, you could look at the double bottoms and triple bottoms further down and club all of them as stage one. And technically, that's fine. We don't do it. Practically, we only count accumulations once the downtrend is finished and prices has moved up, because that's the point where institutions may actually be buying. And when you look at inside the base, you will inside this base, stage one base, you will often see this heavy volume buying and selling candles, and yet the base low doesn't break. So that's the footprint. Somebody is accumulating there. Okay. So something, yeah, two things I want to be straight with you about. The first is that the breakout of a stage one base is usually not smooth. It fails, it comes back, it grinds sideways. So we ignore it. We are not trying to catch the very first breakout. We let the stock prove itself and we take the cleaner setups that come later in stage two. There are plenty of them. And the second is bigger. A stage one base and a stage three distribution base look identical while they are forming. Identical. There is no way to tell them apart while it's happening. The only thing that separates them is what prices does afterwards. If it breaks and runs, it was the stage one. If it breaks down, it was the stage three all along. So we treat a base as a possibility rather than a certainty, and we plan our trades that way. That's why the arithmetic from part one, the arithmetic that we discussed, matters so much. You don't need to know all this. You need your R small enough that not knowing is affordable. So here's one stock through the full cycle, Jamna Auto. This is weekly chart with, you see the black line, that's 200 DMA. So before you look at the boxes, just follow the black line with me. So see it rising here and then rolling over and then falling, then flattening out, then rising again. That line alone tells you most of the story. Now the stages on the left side, this is stage four, the line is falling and the price sits below it the whole way down. Then the line flattens and prices start crossing back and forth. That's the stage one base. This has been marked, right? We have marked it in the box here. Then the line turns up and prices stays above it. That's stage two. That's the run. Then the line flattens here, up here, right? And the price whipsaws across it. And this is a long stretch of stage three. Okay, then it rolls over again and we are back to stage four. So one thing worth noticing here is, see this stage one and this stage three looks similar on this chart. So flat line, prices are crossing. The only thing only thing telling them apart is what came before it and what came after it, right? That's exactly what I meant on the last slide. So, so let me show you something, and I want you to answer this. Look at this, right? So, if people know it, right? This is ascending triangle, right? And this is also a consolidation, right? So there is a clear resistance, the clear ceiling. There are contractions, right? The volume is good, right? The volume is good on the upside, weak on the downside. Range is narrowing, right? And the lows are also getting up, okay? And then there is a breakout, right? So what do you think will happen to this stock now? It will go up or it will go down? You can put a comment, uh, up or down. What is your expectations of this? I'll have water then. I'll wait for your answers. As Chirag, it's right. Okay, so I'll come back to this. So yeah, most of you are saying yes. Okay, and you should have. This is proper bullish structure, no doubt about that. Right? There is nothing wrong with what's visible here. As far as you can see, this is a proper textbook setup. But let
But
me zoom.
Sunny, we are not able to see the prior trend.
Yes, yes, that's exactly I wanted to see. So this is your structure, right? The whole consolidation and the breakout. This happened below a falling 200 DMA. So this is stage four. So nothing about the entry could have helped here, right? A tighter stop wouldn't have saved it. A better pivot wouldn't have saved it, right? The structure underneath was pointing the other way, right? And the stock carried on down afterwards. So this is why I wanted to illustrate the point that stage comes first and why we do it on weekly. Everything you can see in that zoomed in picture was real. This one, it just was not the whole picture. And yet, some people have right. Some people have told this, and they're right. This is so most of them would be knowing this then. Okay, so let's move on anyway. So I wanted to introduce you to one indicator that we use. Okay, it's called Trabot VR signals, and VR is volume and range. So we have built it for trading view. If you search with this name, you will get it. Okay. So now what it flags is a candle where volume is at least twice the average. That's a threshold for something worth looking at. Ordinary activity doesn't get marked. And how it picks the color, and we'll see that in the upcoming charts. How it picks the color is where the price closed inside that candle's range. So close in the upper half, it shades that green, lower half is red. So heavy volume shows possible institutional activity, and the close gives us an estimate of what that activity could be, buying or selling. So it's just an indicator worth watching. And sometimes a candle is hard to call, right? Heavy volume, close near the middle. In that case, it uses the follow through over the next few days to work out which way the activity was leaning. One thing to be clear about, this isn't a buy signal and it doesn't tell you what to do. It just puts the shading where the volume and range together suggests something happened. So your eye goes to the right candles instead of scanning the whole volume panel. So second filter is structure. So fourth thing that takes a base off our list. First, a wide range consolidation where the lows are not moving up. Sideways is fine. Sideways with flat lows is not fine because nothing is being absorbed. It's just drifting. Second, no clear volume footprint. No buying volume anywhere in the base. No sign of support coming in. If nobody is accumulating, there is nothing to break out. Third, more volume on the downswings than the upswings. That's selling with conviction without and buying without conviction. And fourth, look at the two pictures on the right while I say this. Price takes a long time going up and very little time coming down. The top one is the one that we want. Sharp moves up, shallow pullbacks, and the lows stepping up. That's a stock that bounces. Somebody is waiting underneath. About the bottom one is what we avoid. A slow grind up, then one fast drop, and that gives it all back. And the low stays flat, right? That's a stock that doesn't bounce, it just lands, right? That's this is all tennis ball idea. A healthy stock bounces, a weaker one does not. So any of this four is enough to keep us to help us drop the stock. We are not trying to force our trade through every base. There is always another one next week. So what do we actually need? It's simpler than you might expect. At least two contractions with the lows moving up. That's it. That's the structural requirement. The lows moving up is the important half. Each pullback finds buyer earlier than the last one did, and that's supply being absorbed. And it's the one thing in the structure that tells you that. Right? The high should be roughly at the same level or lower, not much higher. If the highs are climbing away, this isn't a base. The stock is still trending, and that flat ceiling is useful because there's still overhead supply sitting at it, right? And that's the level worth breaking later. Two is a minimum. Two levels, two contractions is the minimum, not a target. We are not counting to a magic number, and we are not measuring the depth of each one. Two contractions with rising lows and a flat ceiling is the point where the structure becomes worth watching. Now we wait for the stock to tell us if it's ready. So here's the sequence in order. One, we have the sideways base, two contractions, low rising, highs capped. It's on the watch list and there is nothing to do yet. Two, an up move breaks the swing high. The swing high we are talking about inside the base, and I'll show you the examples. This is the readiness signal, and it is the step people skip. because in most of the things, right? So we need this readiness. If without readiness, you cannot trade those bases, and we will see that in the examples too. So now what happens? The prices pushes through the recent swing high, which tells us that the selling that was capping it is getting absorbed, and the stock may be ready to move up. Without this, you could sit in that base for another 3 months guessing, right? So three, we wait for the pivot candle. After the high has been broken, then we wait for the pivot candle. It usually comes as the next small contraction after that push. This is the candle everything hinges on, and it has a specific description, which is the next slide. Four, the high of that candles becomes our pivot, not the top of the base, not a round number, that specific candle's high. So what does a pivot look like? So a pivot candle is having a volume which is below average. So 20-day average or 50-day average, either is fine. Don't get stuck with which. The shape doesn't matter. It should not have a large negative body. That's it. If it is bullish, better. But that's a preference, right? Not a requirement. Now, here is why low volume matters. And that is a part to hold rather than an exact number. Low volume, there is telling you that there is an absence of supply. Nobody is offering stock at this level anymore. The sellers who were capping the base have been absorbed, which means if prices move about that candle's high, there is likely nothing standing in its way. So that's what the path of least resistance actually means, right? It's not a phrase. It's a description of what's sitting above you. And then there is one rule I want you to remember. The volume on the breakout candle has to be higher than the volume on the pivot candle. If it is not, nothing has changed. That's just another low volume candle, and it's telling you the same thing the pivot candle told you, that not much is happening. It isn't a breakout yet. So now how to enter? Two ways to enter. Either you do a partial position when the pivot breaks and rest once volume confirms it, or the whole positions near the close of the market, if the price is still above the pivot and the volume has come, and the stop goes at the pivot low or the swing low, whichever is near. So now imagine this, right? Look at where we have got to. The stop is tight because of everything we did to get here. The weekly stage check, the structure filter, waiting for the swing high break, waiting for the low volume candle. So tight stop is not luck. The whole process was built to produce it. Okay, so small r. That's the edge. That's the entire session arriving at one candle. So now let's do a real one, right? So this is Inox. So you look at, so we have already marked. So this was our qualifying move. So this is an uptrend. This is 200 DMA. It is moving up. Okay. So you see these contractions. The 1, 2, 3. Here the base is, the lows are not moving up. Okay. Then this one happens, right? So it breaks the high and it forms the first contraction here. So is this a pivot? So this the high has been broken, the swing high has been broken, it comes down, right? Could be, yes. It has got low volume also. I forgot to mark this one, but yeah, it has got low volume. The volume is this, you see in the volume, black line is the 50 days moving average of volume. So this is below that. Okay, what happens next is the price doesn't cross this one, but the volume starts coming up, right? And then this is the day you could have entered. Now look at this one, right? So one thing, so this is discretionary whether I'll be trading this or not, because this low is formed at below midpoint of the base, right? So whether you trade, whether you don't trade, it doesn't matter, because your R is so small, right? That this up move gives you an opportunity to exit partial position. So there are a lot of ways of exiting, right? So once a trade has moved up, we don't we make the trade break even, right? We exit some partial position so the trade is break even and we trail stop losses. Okay. Otherwise, also it comes down and then takes out your stop loss. So you lose 1 hour, right? But if you have done this, you have already captured this at least 3 hour. Okay. So forget about this. Now let's come to this one. The prices come back again. It's still inside the base. The swing high is broken here. Okay, this was the swing high inside the base. This is broken. The prices come down. Now, question is this the pivot? Okay. No, this is not, because of the volume. The volume is still heavy. This is just buyers and sellers struggling with each other, right? So there is no what you call this absorption of sellers, or sellers not selling anymore, right? So there is nothing like that. Further, you see this stop loss, this is 8% stop. So the entire edge of our system is based on the low risk, right? The low R, the low distance between your entry and the stop loss. But this 8R is too much for us. Okay, so we ignore this. Now what happens is, since it has already broken the high, it is ready. So it makes another high. Okay, and then this gives us another R. So look at this one. So look at this candle where the volume again goes down, right? So this is our pivot number 3. Okay, and this is our trade. So this is identification. Now see, these are not actual trades, it's just an illustration, and of course we have cherry picked the trades to show you this one. Okay, not everything behaves like this, not everything is that smooth, and that's the trading, that the fun is all about. Otherwise I'll be winning on every trades, right? So this is what happened, right? So this is entry, this becomes your stop loss, not the pivot low. This is your pivot candle, this is the path of least resistance, line of least resistance. This will be your swing low, and this is where your stop loss sits. Okay, so let's see what happened to this. So this was your entry. Okay, and this is, so this is one of trade, right? Nothing, not all trades behave like this. Okay, but this is what happens. So this is what asymmetric means, and this is why we named our system as Trabot asymmetric pivot method, TAPM. Okay, so this is what asymmetric means. Your risk is this, your reward is this, right? There are multiple ways to exit this trade, but as long as the trade is working fine, we just let it run, right? So this is capping your losses at 1 hour and letting your profit runs, which is quite the other way, right? What most of the people do. So this is one illustration. I have few more examples. So this is Granules India at in June. So this was the base. So this is 1, 2, and 3. Now look at this. In this base, the lows are moving down. This is at the same level. This moved down, right? So, or what I have done is I have marked this as one contraction. Okay. So now this was a pivot, but then this will not be a pivot because our base is not ready yet. It is moving low. There is no high break off swing. Okay. Then, sorry. Then what happens is this comes. Okay. So now this has broken the high, but and then this is a small retracement which happens, right? Now this looks like pivot, or this looks like pivot, but it isn't. It's for the same reason that this is a high range candle. It cannot be a pivot candle. The volume is also above the average, right? So this is still buyers or sellers struggling, not a complete supply absorption of supply. Uh, Another reason for this not being a pivot is that this is your first contraction, right? There is no low which is a higher low. So if I take this as one contraction, there is no second contraction. It's too early to say that. We need second contractions. So now once this happens and the prices moves up, so this is my swing high, this moves up. Now my stocks get into ready, right? Readiness stage. Now I will start actively looking for a pivot and see what happens, right? So this is a small retracement. Look at this one. This was pivot for me, but it high didn't break. This was also pivot and this was also pivot. Now this is where the pivot reversed, the high broke. Now look at the volume. Look at this volume and look at this volume. The volume is more than the pivot volume. Am I clear, right? It's clear. This one. It's small, I know. I try to make it big, but it disturbs the entire thing, right? You can see all in one. But this volume on this green candle is more than the pivot day volume. And this is your entry, right? So we have entered almost at the close. Okay. This will be your stop loss, which will be the swing low or the pivot low. Look at this. The entry and the stop is at 4.5%, right? Next slide shows what happens with this one. Okay, so you exit here. Okay, I'm just, we have many ways of exiting a system, right? We always carry some portions. We also exit using 50 MA, right? This is 50 MA. But then I'm just for illustration, I'm taking an entire exit at this one. So look at this one. This is a 37% exit after this range broke down here, and it makes you 8R, right? So everything we calculate is in multiples of R, right? This makes you 8 times of what you risked. Okay. Next example is BHEL. So look at BHEL 23rd November. So this is your, again, the bases are moving down. So this is your first contraction. This moves high. second contractions. Now you can say this is a pivot, but then what happened is the high has not breached, right? This is your swing high, last swing high. It has to breach swing high for it to be ready, and then it has to form pivot. Otherwise, what happens if you keep on trading this? This can keep on going on for a very longer time, right? You need some kind of uh, a buying to come in, right? And you look at this, we have this Trabot volume range, right? Indicator, VR indicator. This highlights this green and red. So red denotes that there was selling and green denotes that there was buying. So these are the candles we bother. We don't look at the entire stuff. So these are the ones. So it looks good. Then what happens is since here, there were a lot of green candles, means institutions were accumulating. Then at this point of time, right, there was no pivot because there was no readiness. After this, this moved up. So this was the readiness here, right? Now, many traders do this, right? So they trade the breakout here and there is stop losses here, right? Which screws our system because the R is big, right? R is our entire edge is based on a small R, small stop loss point, right? So where it comes here, right? So it goes up, then forms a retracement. Now look at this one. Look at the volume on this pivot candle, right? This is low, right? One of the lowest volume. The candle is also bullish. So we buy above the breakout this candle. This is our entry. The stop is here. It is 4.5% stop. So this is what happens in this one. So you can exit at 5R at 22%. So it straight away rose to 22%. You can exit at 5R, or you can keep on trailing with this one. This will give you a bigger R, right? So conservative, this is 5R. So this is all daily charts. Okay. Now next example, Aurobindo. And this is 2040. So this works, right? This works every year. 2014. So this was one base. Okay, look at this green shades, right? This is all buying coming in. And then what happened is this 1, 2, there was no readiness here. Okay, and even though more than that, there was no base that was moving up, right? So after this, there was readiness, this broke out. Then it came down. Look at this one. Look at this average volume and look at the volume here, right? So volume here, so this is our pivot line, this one. And the entry was on the top of pivot, stop loss was below that swing low, right? So stop is 44%. And if you can, if you want to conservatively exit, so this is probably the selling candle here. You can put a trading stop loss here and exit at 3.5R. So this makes 3.5R. Understand one thing, you make 3.5R at 13% rise only because your stop loss was at 4%, right? Otherwise, if your stop loss is 8%, 13% doesn't make you even 2R. Okay, so this is the entire edge that we are talking about. The small r is all about what is important in this session, right? And the session revolves on that edge. Okay, so now this forms another base here. 1, 2, 3, right? So after this, this is not pivot for us, right? Although it moved up, but this is not where we trade because there is no up move readiness. It has to cross this. So it crossed here, and then this was our pivot entry. Look at the volume on this candle, right? Look at the volume on this candle. This is low. This is one more contraction, huh? With a higher low. And then this happened, and then this happened, right? This, so entry is above their pivot, and then stop loss will be below the swing low. Now we will not have a tight stop loss. So this is an area where we can have 6 point, sorry, we have a 6.5% stop loss. When we trade, right, we have a rule, we never go beyond 8%, because then 3R becomes like very difficult to achieve, right? And we want to exit trades as fast as we can. We want to be profitable, right? We want to book profits as fast as we can so that we rotate capital. We don't want to take 10 trades and stuck on all of them. Okay, so this is what happens. And now look at this, there is entry one. So if you exited, it's fine. If you didn't exit, you're carrying this one with a very tight, what you call this, very beautiful risk reward ratio. It in fact gave you much more than 3.5R here only, right? And this is a second entry. Let's look at what happened after this one. So your second entry, this is somewhere where we exit, right? Your first position, this one made 17R. This is a 80% rise, okay, from this position. So you from this, it is a 80% rise. This made 17R. Even your this position, right, with 6.5 made 5R. 29% rise, right? So this was 6.5, you calculate 6.5 into 5 is somewhere around here. Okay. So this is one example. Now, fourth example, this is all historical data. So yeah, so this is first contraction, second contraction, the third contraction. See, the lows are moving down, right? we need a higher low, right? So the higher low came here, this one. Okay. And then, okay, no, this is not the higher low. So this is low at the same base. So this is little tricky. What happened is the prices moved up. There was a readiness here. Then there was a higher low that formed. Okay. So this is a higher low. So we say that setup is now being ready. So this is our entry with a stop loss here, right? This is the small candle here is a pivot. Look at the volume here. And then the volume started increasing in this candle, right? You can enter here, you can enter at top of this one, right? After confirmation. Then what happened with this one is the prices moved up, right? So this is one of cases where there's prices just blast upwards, and not everything behaves like this, right? As I told you, these are cherry picked examples just to illustrate the point that we are making. Okay. Another is Newland Laboratories. Okay, so this is your first base, this is your second base. The lows are moving up, right? And then this is your high, the high broke, right? So it is ready now. Now we wait for pivot. And this is, see, this low volumes. One more thing, if you notice inside the base, right? So we said that the lows should be with decreasing volume, the high should be with increasing volume. You can find this case. This is the low contraction, which is decreasing volume. Whenever the prices move upside, the volume is increasing, right? So this are characteristics of a good base. And then this forms your pivot here. This is entry is here, stop loss is at 6. This is a 6% stop. And then this is your result, right? So even if this you book here after this fall, it's a 5-hour exit, 30% move. Okay. So this is what the asymmetric pivot looks like. Okay. So now I can provide you more examples. There are a lot of examples, right? Once you start looking at this from this framework, right, you will find this kind of examples, right, everywhere. You will be able to match this. Okay. Uh, Now, last thing I wanted to cover, right, before we go to the questions. Okay, let me quickly tell you where you can find more of this. Okay, so we have a Trabot school on our website. We publish articles there on this method, all free, and they go deeper than this hour allows, right? If any of today was useful, that's the place to carry on. On LinkedIn, we regularly post historical charts of this exact setup marked up purely for learning. And if you want to train your eye, following us there is a good way to do it. Okay. There is also a WhatsApp announcement channel that we have for Trabot Solutions. We post there whenever something new goes up. The link for that is on our website. There are private groups attached to it, but those are our course mentorship groups. And of course, there is a course that teaches the whole system step by step with a community of traders running the same method and learning from each other. So those details are also on Trabot school page. It's all written up properly there. So I won't take up your time with it. Okay. So that's the presentation. Thank you for staying with me. Now over to you, right? Charts, stages, pivots, the arithmetic, or whatever you are working in your own trading. Then I can pull up some charts and show you if I have to illustrate a point. But just to repeat the earlier point, if I pull up a chart, current chart, while answering something, please take it as illustration of an idea. It is not a recommendation on that stock. Okay. So thank you, sir. Thank you, everyone. Over to you now.
Yeah. Thank you, Sunny, for a great presentation. I think we have a lot of questions in the chat box. You can go through the chat box, Sunny.
Take them. I'll just
Take
change
it
my
from the start.
monitors because, yeah, just give me 1 sec. Okay. Uh, and okay, so I'll open up this slide as well so that I can see if there are any questions. Okay. So if R is too small, then the stock might get stopped out in the little noise also. Yes, exactly. If it is not having a proper base, if it is not having all of that structure that we discussed, right? That structure. See, you cannot trade every small candle because it looks small. You can place a stop loss, right? Or you cannot, for that matter, trade every swing low. because just because it looks small, right? See, most of the things when you talk about swing low, right? Most of the things that you look are in the hindsight, right? It's a historical thing, right? When the low is being formed, that time you don't know whether this low will hold or not. Okay. So that is where the structure is very important. The low should be coming out of the base or in the base. Okay. And you should have all of this, whatever we talked about. So I think that this question would be earlier in the slide, right? Now, I hope it got answered. Uh, but let me know. You can unmute also now, right? Let me know, and I'll answer that again. But this is all right. So and not every pivot gets protected, right? It's not like that. That's why we say, right, we have a 30 to 40% win rate, and there are still six stocks that goes and hit our 1 hour trade. But that's the system all about, right? That's the cost of doing business. Okay. Uh, what do you mean, average for reference, if we sustain above 40 and go up. Okay, so these were the answers for our questions. Test definition of volume. Uh, shall we consider volumes within the contraction? Yes. Yes, you do. So one thing that we do is we look at this Trabot VR indicator, right? It's free. You can also use it. Okay, just search for it on TradingView. If we see many green candles, right, inside a base or just before the base has been formed, right, that's a signal that there is a lot of buying that is going on, right? Institution buying that is going on. And believe me, without this indicator, it actually looks very tough to spot that among all these volume candles. So this is beautiful thing, and I advise everybody to use it. Okay. Lot of green candles on the base, very few red candles makes up a good base, right? That is one thing. Second thing is when you plot this swing highs and swing lows within the base, right? As I said, swing highs should be on increasing volume. Swing lows should be on decreasing volume. If you see swing lows are coming on increasing volume, that's a kind of distribution, right? It's not accumulation. Okay, so yeah, very important thing. And yes, I think we covered it, but yeah, that's the answer. PGEL has similar setup currently. Uh, Yep, Chirag, it might. I'll not go into that because that will become a recommendation. Okay. For that matter, I don't know about PGEL. I'm not trading. It's not on my watch list. We have a watch list, right? So we know what's going on in Nifty, NSE. So for this, do you prefer daily or weekly time frame? Always, stage analysis has to be done on weekly. Daily will look too distorted. You won't be able to map as cleanly as we did, right? You looked at that Inox wind chart, right? How clean it was, right? Once you develop a habit of plotting your stages on weekly chart, it will become very neat and clean, right? Now it can be more neat and higher the time frame, the lesser the noise, right? It can be more neat and clean on a monthly, but then we are swing traders. We hold positions, right? We keep on rotating our capital every few weeks, right? So it's too much of a larger time frame. Monthly is too much of a larger time frame for us. But then the concept is same. It works everywhere, right? So all time frames. Okay. The only thing is, as you go lower the time frame, the noise increases. As you go higher the time frame, the smoothness increases. Okay. Uh, so yeah. So again, sorry, I haven't answered it fully. So weekly time frame for stage analysis. Then we go to daily. So once we have plotted those stages and the boxes and all this stuff, we have identified contractions, we identified bases. Then we go to the daily chart and look at the volumes and look at all of these we talked about. Okay. A lovely session. Thanks. Welcome, Chirag. I hope you got something out of it. Sir, does the win rate depend more on strategy itself or the trader's ability to execute the strategy effectively? So first thing is your strategy has to be good, right? The win rate depends on that. So when you are starting any strategy, right? So you can don't automatically see what happens usually is when you start on a system, once you have back tested and you have formed, your system has to be on based on a logic, right? It has to be logically correct. Like this, whatever we talked about in this session is a logically correct system, right? Now, what happens is when you start a system, right? The win rates, winners takes time to become a winner. The losers get stopped out very fast. So initially you will have your win rate, which is down, right? So sorry, and we are not talking about win rate right now. Sorry, I was answering expectancy. Okay, so win rate is least of my bother. If it is above 30%, I'm good with that, right? If it is about 60, 70%, I'm more worried because a swing system looks tricky if it is like it's more of a curve fitted thing if it is above 60%. Okay, so win rate by itself means nothing. It's absolutely zero. Okay, expectancy, when win rate becomes part of expectancy, right? Your win rate into your average win minus your loss into your losing rate into your average loss. That's your trade expectancy, and that is a number that matters. Okay, now initially what will happen is your expectancy will not show up correctly, right? So you need 50, 60, 70 to 100 trades to get this expectancy correct. Okay, because usually initially winners will take time, like 2 3 months to become winner, and losers will give you losses within a week. Okay, uh, now the question was, does win rate depends on model strategy itself? Yes, it does. You can say that, but it's not important for me. As long as the system has a positive expectancy, you are good to go. Because understand, right? If the positive expectancy number is positive over a large number of trades, you will make money. If it is negative, then your win rate can be 80%, 90% over a. You will just consistently lose money. Right? So this is a number that matters. Thank you so much, sir. I really appreciated that I could rewatch the recorded video. I think Sovit sir is recording. Sovit sir, that's for you to answer.
Yes, yes, it's getting recorded and we'll upload it in 1 or 2 days, and you will be able to see it on our channel after 1 2 days.
Thank you. Sir, is this a system fractal? And would it be possible to use it for day trading on a 3 to 5 minute time frame? See, Martin, the system is fractal because logic is sound. Okay. What happens usually is when we are using this system, right? There is a lot of logic that we had developed, right? A lot of things that we studied and all this we made sense to us, right? And usually what happens is why we are talking this for stocks only, because institutions, it's the behavior of institutions that does it, right? They accumulate and they take a lot of time to accumulate, right? Which reflects in those daily and weekly charts. Then they move up. They are not in a hurry. They are not trading 15. Means there might be systems for that, but then most of the institutions which buy and hold and trade stocks are not doing it on a lower time frame. But then the logic works there, because on a lower time frame there are lower time frame traders who does that, right? The logic works. The move might not be that big, right? The asymmetry that we are talking about, a small R and then gaining a very big R, like 20 R, like 15 R, that might not be possible on intraday. But still, you can check this, right? If the bases are sound and all this stuff, the breakout happens, the volume goes low. The logic is sound because the sellers, the logic is that there is no more supply left, right? The bulls have already pushed it up. There is another hint that there is no more supply left. So likely the prices, if it starts going up, will go up, and this very well should hold in any of the time frames. Okay. So yeah, we so that's all the questions that I can see. Somebody raised a hand also. You can unmute and ask a question. Okay. That's it. So, sir, I don't see any other questions.
Hello. Yeah, if there are no questions, then maybe Sunny, you have already talked about the course.
Yes, yes, it's already there in the website. If somebody wants to join, we can teach that thing. We can teach the same system. We go step by step, right? And everything is there on the website. If you are interested, just have a look about that in our website, right? I've given you the link in the system. So you type
Okay.
Trabot Solutions, you will see that. There is a lot of
Okay.
free stuff also. You can make use of that too.
Perfect. Okay. And I know in this webinar there are a lot of CFT students. Okay, but anybody who has not done CMT, if you want, you can visit YUBHA's website, and you can look about CMT course which YUBHA offers if you are interested in doing CMT. I'm putting the website address in the chat box. You can go to the website and you can check the website. And if you have any queries about CMT, if you are interested, then you can contact us on this number. I'll put the number also. Okay. So you can contact us on this number and the email address, right? So if you are interested in doing CMT, you can contact us on this mobile number and email address. Okay. And if there are no questions, then we can wind up for the day.
Yeah, I think I was raising up my hand, if you can hear me.
Yes, yes, please.
Yes, we can hear you.
Yeah, thanks for the lecture. I'm from Nigeria and I'm a career switcher. I registered for CMT. I'm taking lectures with YUBHA. But to be sincere, a lot of things that was said in this conversation, I followed it. It sounds nice, but I'm not able to apply it practically because I'm new to the entire industry. I checked your website. I saw that you guys offer practical training. So I wanted to know when that is starting because it was not indicated there. And how can and a lot of the examples you've used is based in India. So how can I, be able to work with the wide learning by doing CMT, be able to do some practical trading and the likes. I hope you got my question.
So CMT, and see, this course is something different from CMT, right? CMT is entire technical analysis, right? Your question actually is clubbing both the stuff, right? So what YUBHA does is YUBHA prepares you for CMT examinations, right? And CMT has got, if I think you are part of YUBHA already, right? So yeah, you know about it. Okay. CMT will surely help you because this is not the only system that people can trade, right? So this is one of the system that we trade. We found it beautiful. We do it excellently, so we trade it. Okay, there are thousand other systems, right? And today's session was more about showing you that edge, right? What edge the low risk, like low R carries. Okay, and the system is one of the system which implements this idea of getting an edge in swing trading. Okay, now, if I talk about our course, what we do is basically we launched it recently, right? In July, we launched it. Okay, and it's a recorded course, so everything is there recorded. Okay, so you don't you just have to join, right? You just have to join and then go through the recordings. While you go through the recordings, we do have a dedicated groups, right? WhatsApp groups and all this stuff where you can share your learnings and you can share your assignments and all this stuff. And then it's like a community. So that group, that course, you go through the recordings, you understand what is being said, and then you ask questions. There is a group for that. There are monthly doubt clearing sessions also that we do, and everything that we do is as a community, right? As of now, there are people. There are no outside India people. They all the groups are, and since we recently launched, right? So most of them are trading Indian stocks, but then the system applies equally to everywhere, right? As I said, it's a universal system. I'll tell you where it might differ, right? Like when I checked US stocks, okay, the concept is same. The only thing is that the volume that comes in trading view, right? That is adjusted volume. So there we might not get exactly the pivot. There might be little shift here and there to trade other markets. And to be honest, we have looked into some and we are trying, right? So we are actually testing. This system we almost tested for like 1 year live, and then we have produced a course out of it. The rest of the markets, we are currently doing that. But then, as of initially, we found that this system does work because it's a logically sound system. It's based on and VCP. If you understand VCP, right, there is an entire lineage of VCP traders, and it's a very sound concept. We have our own flavor of VCP. We call it TAPM. So this is if you wanted to know about that. Rest of the things you can go into the website and check it out. Okay.
Of course. Yeah.
No bad.
Thanks so much.
But YUBHA, you coming to YUBHA is different. YUBHA prepares you for CMT. They have got
Yeah.
live sessions and all, right? We have a product called Checkpoint, which prepares you for quizzes and revisions and all this stuff. That's entirely different game.
Okay. Thank you. I'll check back with you guys.
Sure.
Okay. I think there are no other questions.
Okay.
So we can wind up, Sunny.
Yes, yes, sure. And you can reach us at the mail ID that is there in the thank you slide. Okay, we have given our mail ID. Any questions you have in future, or you know about, want to know about the course, or even if you don't want to join the course, right? You can always reach out to us. Oh, so thank you for bearing me. Okay, have a nice day, everyone. Thank you so much, sir, for hosting me.
Thank you, Sunny. And
Thank you.
if you are not able to reach Sunny by any ways, you can reach out to us and we will help you reach out with Sunny. Okay. Thank you. Bye.
Thank you.
Bye. Everyone.